Oh, hi. So, I've been reading this book for an hour or so, and the one thing I'm quite certain of now is that Saurabh Mukherjea did not invent coffee can investing. In fact, it was this man, Robert G. Kirby, who first wrote about it in 1984. We'll get back to Mr. Kirby in just a minute, but one has to wonder why use the phrase coffee can in the first place. Well, the name and concept dates back to the Old West, the early 19th century. It was a time when people would put in their valuables like money and jewelry in a coffee can and keep it under the mattress for safekeeping. After many decades, a young Robert Kirby accidentally came across the investing version of the coffee can concept. So what had happened is that one of his clients had deceased, and when Mr. Kirby analyzed his investment portfolio, he found the one big mistake that client had been making for many years. You see, while this man had invested in every stock that Mr. Kirby's firm had recommended over the years, he had been ignoring the sell recommendations. In other words, the client had been putting away the share certificates in a box and had completely forgotten about them. Of course, weeks became months, months turned to years, and the client's accidental patience had converted into a massive fortune over time. More importantly, this interaction offered Mr. Kirby a number of investing lessons. Let's look at a couple of them. The first is the presence of a multi-bagger, which is nothing but a stock that has appreciated your capital multiple times. In an Indian context, I'm talking about catching companies like Bajaj Finance, Shree Cement, Titan, Pidilite Industries, etc. when they were very young and to ride that one gigantic wave over many years. In fact, one multi-bagger can change your life, and in Mr. Kirby's case, it was his client's small investment in Xerox which did the magic. Even mathematically, the table here shows how just one 100-bagger can have a profound impact on portfolio returns even if the remaining stocks fail to materialize. And the fifth lesson that came out of this is that the success of this investing program entirely depends on what you place inside the coffee can. In other words, the stocks that you select should be the ones that offer you the highest probability of success, and the identification of such stocks from a plantation of companies will be our quest for the rest of this video. Alright, so this book is not entirely about coffee can investing. In fact, half of the book is on basic investing concepts like financial planning, direct and regular plans, small caps, ETFs, real estate, taxes, etc. The meat of the matter, that is the coffee can part, is there in chapter 2, chapter 6, a little bit of chapter 5, and of course there is the appendix at the end of the book where the authors have given detailed statistics and year-on-year portfolio performance. While the book could have been structured better, it does shed light on three areas which I would like to adapt and discuss in our study of coffee can investing. The first is on how one can identify a high quality business. Second, how can you implement coffee can investing? And thirdly, we look to extract a list of companies that should more or less fit the coffee can investing framework as of today. Let's start with what constitutes a high quality business. Now, the easy but impractical definition would be to say that it's a business with outstanding financials, a great management, a business that has low debt, and one that enjoys an excellent competitive advantage and brand value. But functionally, we are essentially looking at four major characteristics. The first is business longevity, and for a company to qualify, it should have been operational for at least 10 years. Then comes revenue growth, and we are looking for companies that have grown by at least 10% every year over the last decade. Please do note this isn't a CAGR of 10%, and per the coffee can rules, we have to be looking at companies that have grown by at least 10% in year 1, in year 2, in year 3, all the way until the 10th year. The next filter is the return on capital employed, which helps us understand how efficiently the business is using its equity and debt to generate returns. The coffee can framework considers an ROC of 15% to be an ideal characteristic of a quality business. And the final filter, as per Robert Kirby's original work, is market capitalization. And we are only looking at those companies which have a market cap of at least 100 crores. A market cap of 100 crores or above allows for over 2,200 companies in an Indian context But this should not give you the impression that a coffee can portfolio will have a lot of microcap companies in it. On the contrary, most coffee can portfolios have a number of very popular large cap companies, as every investment firm applies a number of additional filters such as a steady positive free cash flow number, high market share, low debt equity ratio, etc. The first step in developing a coffee can portfolio of your own is to apply the filters that we just learned in the last section. But as I have myself found out, some of these filters can be very difficult to implement for an average investor like you or me. Like this one, for example, where the revenue numbers of each of the last 10 years needs to be pulled up to check for a minimum 10% growth in every year. We can also use the 10-year CAGR as a shortcut, but I've been trying to do this the hard way, and in the last 20 minutes, I found just 4 popular companies that had seen at least 10% growth in 9 of the last 10 years. Now, once you get the hang of it, your next objective should be to identify 20 to 25 stocks from this list. Preferably, these stocks you identify should be from multiple sectors, because we are aiming for those 1 or 2 multi-baggers, and we really don't want an industry-wide disruption to upset our games. The third step in the coffee can investing framework is to invest an equal amount of money in each of the stocks. This not only reduces any selection risk, but also gives every company an equal opportunity to grow and flourish. And the final step in the coffee can investing process is not something you have to do. It is something you should not do, and that is, don't churn your portfolio. In other words, don't sell any of your coffee can stocks, don't rebalance, basically don't do anything that attracts a transaction cost. One way of investing in a coffee can portfolio is to do it yourself. It's not very easy, it's not very difficult, and we've already examined the process steps in the previous sections of this video. But if you don't have the time or the inclination to do it and would rather have professional help, then there are PMS companies like Ambit and Marcellus that can be approached, who offer such portfolios against an investment fee. For instance, Ambit Asset Management has had a coffee can portfolio since March of 2017. This portfolio has some 10 to 15 stocks in it, and it seems to have a large cap bias, with the top 5 holdings consisting of Asian Paints, ICICI Bank, TCS, HDFC Bank and Pidilite Industries. While you can access Ambit's portfolio performance and philosophy in the fund fact sheet, I did find some statistics and metrics which I think is worth a discussion. Let's look at the P ratio in particular, and as it stands, the Nifty 50 operates at a P multiple of 21. In sharp contrast, Ambit's coffee can portfolio is at an astonishing P ratio of 74. Now, on the face of it, a P of 74 might seem very high, but if you choose to look at it differently, this high number might also indicate that the investing community expects these companies to deliver a higher earnings growth in the future. In other words, the business is a lot more valuable in the eyes of an investor, which more often than not triggers a positive re-rating of its earnings multiple, as we can see in this table here. Another PMS which has been popularly associated with the coffee can approach is Marcellus, which is headed by Saurabh Mukherjea, who is also their chief investment officer. Now, like Ambit, Marcellus doesn't use the words coffee can portfolio in its flagship offering. Instead, they call it the consistent compounders portfolio, which borrows a lot from the coffee can approach, including its CCP abbreviation. And a lot like Ambit, the Marcellus team applies its own process of filters, forensic accounting, channel feedback, etc. to arrive at a final portfolio of 12 to 15 stocks. Now, I've been researching on the internet for over an hour now, trying to identify the CCP stocks that Marcellus might have invested into. And while I cannot vouch for its accuracy, here's what I have so far. So the usual suspects are all there, and according to a Money Control article I read, the top holdings of this portfolio includes Asian Paints, Bajaj Finance, Titan, Dr. Lal PathLabs and HDFC Bank. The offerings of Ambit and Marcellus come under the Portfolio Management Services framework, and these generally come with a minimum investment size of at least 50 lakh rupees, which makes it unsuitable for a majority of investors. My next destination was a place I know too well, but a search from over 1,000 mutual fund schemes did not lead me to a single fund that carried the phrase coffee can or consistent compounders for that matter. The next place I searched was small case, and I was pretty sure that I'll find a coffee can portfolio here, but unfortunately here too I came up empty-handed. By now I was getting a little disheartened until someone said I can search for user-generated coffee can portfolios on screener.in. And so I did that, and I was welcomed with over 4,000 of them. It was a problem of plenty, and every user had put in his own twist to the formula by applying additional parameters like net profit margin, quantum of sales, the P ratio, etc. On top of this, these platforms have their own limitations. For example, if you want a list of companies that have exceeded 10% growth in all 10 years, then the screener I would have would not have been able to help you. In such cases, you will have to make do with what's available in the platform, like what one user had cleverly done to identify a sales growth of 10% across multiple years. And finally, there are forums like Value Picker and of course Twitter, where individuals would generously share their knowledge and opinions, including which stocks to invest in. One such person is Gurjot Ahluwalia, who was kind enough to explain his coffee can investing process over a quick video call.
So in my screener, I have put additional filters such as 3 years sales growth of 10%, 5 years sales growth of 10%, 7 years sales growth of 10%, and so on. This will help weed out a lot of cyclical companies which have sharp peaks and troughs in terms of growth. And I did the same thing for the ROCE filter as well. But even this is not perfect. It's the closest you can get to directly identifying coffee can companies, as Saurabh Mukherjea spoke. So once you apply this screen, you are likely to get more than 100 stocks because it's picking up average growth rate and not the year-on-year growth. So this is where you need to do some more hard work as an investor. In that list of 100 stocks, I blindly filter out any cyclical commodity-based companies around sectors like steel, sugar, metals, infrastructure companies related to power, EPC, capital goods, even industries like real estate, along with PSU businesses and sectors which have very high regulatory control or compliance. So after this exercise, you would be left with around 50 or so stocks where you can apply some more filters such as debt on books. So I prefer less than one debt to equity. You can look at unpledged promoter holding. I prefer companies and businesses with at least 40 to 50% promoter holding so that they have skin in the game. And then also look at corporate governance track record. You can search about the management, any SEBI-related violations, fines, criminal cases, and those kind of things. Now, after this, you should be left with about 25, 35 excellent businesses to invest in, where you should also look at the current valuations.
So lots of useful tips here, and I'm sure there are many others like Gurjot who are selflessly sharing what they know over different platforms. Okay, so to sum it up, here's what you really need to know about coffee can investing. Firstly, it's an investment strategy that hinges on finding high quality stocks and holding them for long periods of time. Secondly, it's a strategy that does well across economic cycles and has generally outperformed the benchmark. Point 3 is a bit negative and emanates from the fact that the strategy looks at 10 years plus of operational businesses, which means one might miss out on catching new companies and industries in its infancy, thereby missing out on some huge multi-baggers. Point 4, and we have seen it throughout this video, that coffee can investing requires a lot of initial research and analysis, especially to ensure that you're putting in the right stocks within the coffee can. So these are some points I'm taking away with me, and if coffee can investing really interests you, then do allocate some part of your portfolio, say a maximum of 10% into this strategy. Once again, thank you for your time. Do share this video with your friends and do help me grow this channel. I look forward to catching up with you on another insightful video soon. Until then.